If you want to supercharge your real estate investing, watch this video and make sure you stay till the very end and get the 3 most important aspects that you need to understand when it comes to analyzing a deal to determine even if you have a good deal or not. Okay, let's talk about the benefits of investing in real estate. Like, why are we investing in real estate in the first place? First of all, leverage. Investing in real estate, you have the opportunity to get loans. You don't have to pay cash necessarily for the real estate, and that creates leverage, which is why in some of our other videos we talk about positive leverage. So take a look at some of our other videos where we go into positive leverage and negative leverage, because that is the key to getting solid cash flow in real estate investing. So leverage is a big one. The other one is that in real estate in general is an inflation hedge. That means if you're investing in the right location, it's going to go up in value, even if you don't know what you're doing. Have you ever bought a house just to live in because you like the house, and a couple years later the house is worth a lot more than when you originally bought it? That's because real estate is a fantastic inflation hedge. It appreciates. As a matter of fact, the 2 biggest benefits of real estate investing is appreciation and cash flow. Investing in real estate just to get appreciation is not a good strategy. Investing in real estate just for cash flow is also not a good strategy. I'll give you an example. You can go invest in real estate in California, in some areas in California, which appreciate greatly, but they don't cash flow. You're paying money every month to own real estate that's negative cash flowing. And you can cash out on that appreciation if you're in a strong real estate market and all the stars are aligned, great. But the moment the market changes directions and you're stuck, now you're stuck and you can't access your equity in a house that is costing you money every month. So you never want to have a strategy that is just around appreciation. On the flip side, if we go up to Detroit, for example, there was a lot of neighborhoods demolished, a lot of values went down, a lot of population leaving some of those markets up there. But on paper, there would cash flow like 10, 12, 15% cap rates. Just great cash flow on paper. But the problem is you're buying a house there, let's say for $100,000, $150,000. 5 years later, you're going to sell that house also for $100,000, $150,000. And the reality is all that cash flow that it was showing on paper, you're going to lose a lot of that to turnover and the difficulty of managing a property in a more difficult market. So the best strategy, in my opinion, in real estate investing is a combination of appreciation and cash flow. Now you can mix it up a little bit. You can say have a little bit more appreciation and a little bit less cash flow because it's a sought after and ideal location, or maybe it's not the best location, so a good location, but we're getting a good deal on the property, getting good cash flow. So you want to have both, and typically when you get high appreciation, you're going to get lower cash flow. When you get lower appreciation, you should expect higher cash flow. So it's a balance of those two when you're coming up with your strategy. Now let's talk about the types of investment assets that you could invest in. There's active investments and there's passive investments. Active investments are when you own real estate directly. You purchase real estate, you own it, that's an active investment because you're actively working the real estate. It's not passive. Passive investments are investing in a real estate fund, a REIT, any type of security that invests in real estate. That's a passive investment. In either case, they can offer really nice returns. But across the board, whether it's an active or passive investment, you should only invest in things that you understand. Okay, so investing in real estate that you have some experience with. That's why a lot of people find it easier to invest in single-family homes or duplexes or apartments because they've lived in those things before. They have some experience in what amenities they like, what they don't like, how a mortgage works if you ever bought a house. And so it makes it a little bit easier. And in a lot of cases, most cases, buying your first home is your first experience in real estate investing. And instead of selling that house and buying another house, you keep the house, buy another house to move into and rent that one out. And as long as the second house is also kind of a modest home that you can rent out later, you'll live in that one a little bit, buy another one, rent that one out. Follow that pattern and you've got a little portfolio growing, and it just doesn't take a lot to retire. For example, if you're trying to save your way to retirement or to financial independence, very difficult to do. If you utilize compounding interest, which Benjamin Franklin said was the 8th wonder of the world, which it is, Then you invest in different areas via IRA, Roth IRA, 401k, things like that. Still takes a good bit of time, 15, 20, 30, 40 years to really accumulate and really grow and really compound. Okay, real estate investing is a little bit different. If I buy a rental property, the net cash flow from that rental property is going to be higher than money that I'm just putting in the stock market. And primarily because it's not a passive investment, it's an active investment. But other than that cash flow that it brings in, it has other benefits, like it has tax benefits like depreciation. It has benefits like to hedge against inflation, like appreciation. So investing and owning real estate directly is fantastic. You could do single family homes, you could do storage buildings, apartments, office, industrial. Just do me a favor, do yourself a favor, only invest in something that you feel comfortable with, something that you understand and something that you know. And if you don't really know anything about any of those things, then go find someone that does know about those things, get comfortable with that person, vet that person out, then you can invest alongside that person and gain more knowledge that way. There's two things I'm going to bring up here, and you're going to hear me mention these two things a lot. It's fear and greed. Fear and greed will ruin your investments. So when I say use your gut, that means your gut cannot include fear or greed. So if there's fear or greed involved, you need to put that aside, take it off the table, then go with your gut on what feels like it makes sense. But you can't do it under any type of, fear or greed. An example of that is when the real estate market is going up, or any market. It could be cryptocurrency, stock market, when it's booming and people are making lots of money, that's when people buy and they invest. And a lot of times people see their assets growing and they're making a lot of money. They don't want to sell it. They want to wait, sell their shares, sell their stocks, sell their real estate. They want to wait until they max out their returns, and then they potentially waited too long. So timing the market's a terrible idea. So they buy when the market's going up, and when the market goes down, they get afraid and they sell. And they're like, they try to get out and they try to run away from it. In essence, they've bought high and sold low. That is the strategy for most people in this country, because most people in this country are very emotional. And real estate is like this. Most markets are, up and down. But it's the fact that they go up and down is how you make so much money. You get good at diversification, dollar cost averaging, and just investing and buying when people are afraid. When there's fear in the markets, when you buy. When there's, excitement and greed in the market, that's when you sell, period. These are basic principles. They're just hard for a lot of people to fathom. It's hard for people to stomach those things. So you're going to hear me talk a lot about making good instinctive decisions based on your experience and your understanding of what's going on and how you feel about the situation. But you have to put fear and greed aside, because that will completely ruin your investment. Let's talk about how to find the right deal. And when you find the right deal, how to underwrite the deal. Underwriting is just a way of analyzing a potential investment. And when you're underwriting or analyzing a deal, you're really looking at three things. You're looking at the financials of that deal. You're assessing the potential income, the potential expenses, figuring out what the NOI, the net operating income might be, assessing it from a value or basically a cash flow standpoint. You're doing a cash flow analysis. The second one is to analyze the market or the location. And the third one is to analyze your management team. The property, the location, the management teams, those are the three things you have to underwrite on every deal. The team's important because you have to know that you have the ability to execute on a business plan or the strategy that you're trying to execute on. The location is very important because the location affects your appreciation. Whether the deal pencils only and affects your cash flow, that's just one of the elements. If I have a project that pencils, it cash flows well, it's in the right area, that area is growing in population, people want to be in that area, they like that area, but you don't have the right team that you feel comfortable or you're confident that you know that they can execute on the buy, the renovation, the management, all that stuff to get it to perform the way you want it to perform, then you can't do the deal. I've got some projects that if I'll buy a piece of land, maybe 50 acres or 100 acres, and I want to develop into a subdivision or mixed-use development or community or anything, and it may be in the right area. It may be well priced, and rents in that area are great, incomes in that area are great, but if I don't have boots on the ground, if I don't have the team that I feel confident that can execute and pull off the strategy, it's not gonna work. Because if you have the right team, they can take a bad deal and turn it into a good deal. And if you have the wrong team, they can take a good deal and turn it into a bad deal. So you've got to have confidence in your team because they have experience. Maybe you have experience with them, or you feel good about their track record and working with them. But in finding a team and finding people to work with, don't just work with the first person that you find. Make sure you've interviewed people. Make sure you've taken the time to, meet a number of different people. Your operations team, your management team is so important to your strategy. So make sure you vet them out and find the right team. So you just need to understand what your underwriting metrics are. When you find a deal, there's always going to be a due diligence period. We're buying this deal under certain assumptions. We're going to buy it, put it under contract, put up some earnest money. We're going to have a due diligence period, at least 60, 90 days, where we can go through all our information and verify it is what it is. Then you'll have a closing period after that 60 to 90 days, which is usually another 30 to 45 days. Could be more or less depending on the terms and how awesome or not awesome the deal looks. Let's talk a little bit more about analysis on a property. So if you're buying a cash flow property, you need to understand what a cap rate is. Cash flowing real estate trades on cap rates. That means if you were to take all of your income, all your gross income, you minus out all of your operating expenses. This does not include a mortgage, by the way. Then you have a cap rate. So you're assuming that if I paid cash for this property, no debt, paid cash, took my gross income for the next 12 months and subtracted my operating expenses for the next 12 months, that's my net operating income. And I can take that net operating income, or NOI, and divide it by my all-in cost, basically however much it costs to buy the building and even renovate it if it needs to renovate. So, and different assets have different cap rates. Residential has certain cap rates, maybe 5-6%. Storage buildings, it could be 6-7%. Office buildings could be 5%. Retail, all of them have different cap rates. Cap rates are based upon risk. When you invest using a loan, that cap rate turns into a cash-on-cash return because it assumes that you're not putting all of the cash in, and it deducts the mortgage payment from your cash flow, gives you a cash-on-cash return. You also need to understand how to calculate an IRR, or internal rate of return, and this is done, really, you can use an Excel spreadsheet to do that for you. You just got to put in all the inflows and outflows, and it gives you the IRR over whatever period of time you're planning on holding the property or executing your business plan. And that IRR is, in essence, an annualized return. It takes in all your cash flows and then your sale proceeds at the end and gives you, hey, this is using the time value of money. This is my annualized return over the life of the deal that I've executed. So those are the main ways a lot of people will look at analyzing the financials on a real estate investment. Sometimes they use things like an equity multiple, which means I put in this much cash and I doubled my money, that's a 2x. If I tripled my money, that's a 3x, something like that. There's gross rent multiples. I keep hearing about this 1% rule thing. Obviously, that does work. We did that 10 years ago or whatever. It does work. A number of different type of metrics people use. The ones I just explained to you are probably the most practical or the most helpful, really, from a financial analysis standpoint. Thank you for watching the video. Make sure you like, subscribe, and comment. Really comment with your feedback, comment with your questions. I love to interact with people watching my videos. And if you want more information about what we do, you can go check out our fund website, which is arabellacapital.com. We strive to help investors get at least 8 to 12% cash flow on an annual basis and grow their portfolio and the value and their net worth. Look, that's what real estate's all about. Let's go on this journey together. Let's have some fun together.